When it comes to tech stocks, they're crushing it. So says regular guest and Handelszeitung columnist Ken Fisher, who's joining me back in the studio today. We also have Melanie Loos from the paper too to grill him on his latest thoughts. Welcome, Melanie, and welcome again to you, Ken, as well. First up, Ken, if I can just ask you, you say tech stocks are crushing it. I mean, are they outperforming globally?
Tech stocks have been leading the world market consistently since 2017 and actually overall since about 2015. In fact, so much so that if you think of the way most people think of the outperformance of the U.S. stock market, it's almost totally, almost 100% due to tech stocks and tech-performing-like communication services stocks, which the two together, 16% plus and 8% plus, make up a quarter of the U.S. global stock market, but are concentrated almost solely in America. Said another way, if you take all of the continent of Europe and you look at the relative performance between America and Europe, and you take the tech stocks out of it, the two categories have performed the same. It's tech that has made America look better because tech basically is an American thing.
Yeah, and given that it's doing so in the US markets, boosting US markets, on the other hand, here in Switzerland, we don't see any of that because, I mean, the SPI, the Swiss Performance Index, is very little or tech stocks are very small fraction of it. But still, the SPI has been outperforming this year as well. Isn't there a slight contradiction, or how would you explain that?
So exactly as I said in my Handelszeitung column, the way you want to see that is not so much that it's tech for the sake of tech, but a different thing, which is actually a regular thing in the later stages of a bull market as they mature. Later stage bull markets normally prefer huge stocks with household global names that the last person to get into the bull market buying, who had been too afraid to own anything earlier, feels comfortable with. Even if they're wrong about where the market's going, they think it'll be there because it's healthy, got global reach, has fat gross operating profit margins, meaning revenue minus cost of goods sold, so that it can finance the future of marketing and research and everything else, and then has strong balance sheets. It feels safe to that late stage buyer who was too afraid to own anything before. That is perfectly Nestle. It is perfectly Nestle, which makes up 20% of the Swiss stock market. And in fact, if you look at a chart of Nestle, it just looked like a straight line all this year. That's steady, reliable. If you think of, I mean, Nestle has 50% gross operating profit margins, which is for a food-oriented company really high. It's the high quality that late-stage markets like. The money-weighted market cap of the global stock market is 160 billion US dollars. And it's the stocks bigger than that, which include the mega tech stocks, the FANGs, the famous names everyone knows, but also includes all the rest of that mega cap quality growth area, with one big exception, which is drugs. And other than the drugs, where there's fear about pricing controls, the rest of that category is doing really well. And Switzerland's got that in particular with Nestle.
Okay, so if Swiss markets are doing well, it's because of the big defensives, which we always talk about on the programme. So when it comes to the likes of Logitech, Temenos, AMS, these are some of the kind of tech stocks that we have here in Switzerland. I mean, how do you see them as players? Are they big hitters? Are they small players? You know, where do they kind of feature for you?
So they fit into the smaller realm. And what typically happens in the way markets perform, and this is just a general rule, it works not perfectly, but almost perfectly all the time, and has since long before I was born. And that's a long time ago. The fact is, the realm and the time for those kind of stocks is in the first roughly 40% of a bull market's duration. They bounce off the bottom strong, and they outperform early in a bull market. And in fact, if you look at that ilk of stock early in this bull market from the beginning in March 2009, they performed exceptionally well, doing better than Nestle, doing better than the world market. That part of the market led very nicely and will again when we get to the early phases of the next bull. The part of the problem for everyone, of course, is understanding, is the market in a bull market and a bear market? And then if it is, what are the kind of stocks at this phase of it that do well? And the typical time for those kind of stocks is early in a bull market. The typical time for stocks like Nestle is late in a bull market. And what a Swiss investor ought to be thinking about now is getting a lot of that big mega cap, high quality, super household global name type company from outside of Switzerland, because there's a lot in the world, again, heavily American.
All right. But exactly about when you talk about this timing, markets have been soaring for years and they're still booming. How do you know that you're talking about the end of a bull market, which is right now? How do you know this is going to happen, and when do you expect a bear market to follow?
Well, I don't know when a bear market will come, but I go back to something that I've said in Handelszeitung numbers of times and will say numbers of times again, which is that the best single way to think about that is legendary investor, long deceased John Templeton's famous phrase that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die of euphoria. And that's not always true, but it's almost always true. And we're a very long way from euphoria in this world. People are so concerned about all the laundry list of worries that we hear about all the time that the market, in traditional market lingo, keeps climbing that wall of worry because we still have plenty of things to worry about. As long as the world's got an adequate degree of skepticism in it and doesn't tilt too much to optimism, past it to euphoria, the bull market wants to continue.
So are you telling us then that, investors should kind of hold off investing in Swiss tech stocks right now?
I don't think this is the time for Swiss tech stocks. I think this is the time for the big mega cap tech stocks that are easy for the last person who gets into this bull market just as it's dying to say, I feel comfortable with that. Even if I'm wrong about everything else, it'll still be there 10 years from now doing well. That's the kind of stock that typically keeps going on until the end, not ones they have to worry about, will it still be here in 10 years?
All right. And what's the rest
That's just the way it is.
Yeah.
These bull markets have been doing this over and over again. Sometimes it's a little different, but only a little different. Sometimes it's drug stocks that lead. But usually it's this big mega cap, fat gross operating profit margin, strong balance sheet, household names, ones that you've known a long, long time, and that last, if you will, if you'll pardon the phrase, the last greater fool to get into the bull market at the peak feels comfortable buying because they're not looking to buy some little needle in the stock market haystack. That's not what they're looking to do. They're looking to make a longer term save.
Yes. Can you explain what should the rest of a portfolio look like? What would you recommend investors from Switzerland?
So first, my first recommendation would be to have roughly 25% of the portfolio in those big mega cap tech and maybe another 10% in big mega cap communication services companies. That's going to get you up to about 35% of the portfolio. The next parts that really want to be focused on is you want to have, and this is easy to do, a fair amount of mega cap energy. You want to have some exposure to other high quality consumer staples and a little bit consumer discretionary stocks like, let's say, France's LVMH, which is, oh, by the way, doing very well. And then you need to diversify so you have a little bit of what would do well if all those things did badly, which includes some big drug stocks, and that basically should make up your portfolio.
Okay, Ken Fisher, thank you very much indeed for joining us again, and thank you, Melanie Loos, as well.
Thank you.
Okay, plenty more still to come on the programme tonight. Stay with us, and remember, all our content is available on our website, cnnmoney.ch. Bye-bye.